Hi everyone, welcome back to my deep dive into Rivian. This is part 5. In part 4 we stopped about the capital development in Rivian, and we talked about potential raises, some of the ramifications, but I would like to emphasize why that is so important. When Rivian raises capital, and as I said, it can only be equity, it will yet again increase significantly Rivian's share count. This makes any future profitability in years 2028, 2029, etc., much less valuable because you're dividing every dollar in earnings over a much higher number of shares. That's what it ultimately comes down to. And as soon as the market basically takes note of that, the pricing in starts. And this was the precise reason why we saw the long-term lows in Rivian stock in early 2024, because people finally realized, okay, Rivian is running out of capital and they're coming to market soon. Business is not doing well, and they priced in the dilution. And then once the VW JV was announced, share price spiked up again because now this what's called capital overhang was removed from the stock. So I anticipate the exact same scenario in the not too distant future. Right now it seems like everybody thinks like, oh, Rivian is sufficiently capitalized because of this huge DOE loan, plus of course VW investment, all things is good. But as you'll see, when you model everything in a consistent manner, you can see there's still a significant capital hold. So with that, let's just look at sort of the margin development. So the total gross margin in 2023 was 46%, improved to 24% in 2024. I expect, or I should say the forecast implies a modest 1% gross profitability. And again, this is across the entire business, not just auto. And that improves to 9.6% in 2026 and 19.3% in 2027. So that is actually a pretty good gross margin for an automaker. I'd like to point out one important accounting distinction. Some automakers move R&D into cost of revenue. This means all these automakers show a higher cost relative to other automakers reporting R&D expenses in OPEX. This means when you compare one who does that and one who doesn't, the one who does include R&D in cost of revenue understates the apples to apples gross margin. And this is the case often in European automakers. However, one thing that European automakers use to offset that effect is a large capitalization of R&D expenses, which US automakers or US companies in general typically don't do. But this is also exceeds the scope of this presentation, but I'll discuss this in another analysis. But just keep that in mind so you're not falling for the obvious traps in terms of financial analysis. So then when you look at sort of the individual segments, auto, S&S, and I also break out credits because I find credits, because they're pure profits, they're really pure profits, highly noisy if you include them in these product lines, and especially given the changing environment politically in the US and Rivian's dependency on credits. So when we look at auto, the picture is not quite as favorable as the total gross margin would imply. Auto in 2024 was 39.7%, and by the way, the reason why I'm not showing auto gross margin for 2023 is Rivian significantly changed its segmental disclosure, and we do not have enough information to break this out in a consistent manner. And that's why before I show you apples and oranges, I rather not show you the number at all. But I can tell you this was also deeply negative. So then in 2025, there's a substantial improvement. So this is driven by, and keep in mind 2025, there's still only the R1 and van platforms, and the forecast assumes continuing strong ASP, so ASP is average selling price development, driven by a strong mix. The CEO talked about the high take-up of the new three-motor version, and there's also a quad-motor version, but they have some problems with that one. But anyways, so the forecast is optimistic on this page, so strong ASP Plus, Rivian can continue to take out cost from production cost, and Rivian also talked about this on the earnings call a few days ago. They said they expect throughout 2025 a continuing strong raw materials, or they call it commodities tailwind. So the forecast accounts for that. Forecast also takes into consideration Rivian's comments around the mix relative to consumer and commercial vehicles. So commercial vehicles comprises Rivian's delivery van. And then 2026, there's a significant further improvement. And this is based on an assumed continuation of the favorable trend of the R1 and van platforms, so continuing strengthening of ASP, improving production costs, plus the onset of the R2, which is assumed to hit profitability only 3 quarters after ramp, but we'll discuss this in much detail in a later part of the series. And then the forecast, so this gross margin improvement in order to 13.2% in 2027 reflects that the R2 really takes over kind of Rivian's business, just as the Model Y did in Tesla's business. First there was the Model S and X, and then the Model 3 took over, and then later the Model Y took over from the Model 3, and this is kind of what this number also reflects here, but we'll discuss this also in great detail much later. Then we look at the software and services gross margin. Keep in mind that this comprises services and other, which tends to be a low margin type of business, and VW JV. Here there is an issue with that gross margin, and I cover this later in the presentation, but for now let's keep it simple. This reflects Rivian's guidance. The CFO said that Rivian expects for the whole of this segment a quote 30% area gross margin. So the forecasting reflects it, but she made one comment that actually conflicts with some other comments she made. But I'll discuss this later. Then you have credits. Credits is, you see here, crazy 100%. Why? Because it's just revenue minus no cost equals profits. That's why 100% gross margin. And then ultimately taking into consideration R&D and SG&A expenses, you get to operating margins reflecting all the costs almost, and you get in 2024 the operating margin was negative 94%, which is like insane. And keep in mind this business has been selling now vehicles for over 3 years, and anyway, let's not get into that. But in 2025, based on all the assumptions of the forecast, we dropped down to negative 59%, which is still crazy high. 2026, just over 40%, and 2027 still almost negative 15%. And again, this is really, really bad. And then when you look at the net income margin, it's even slightly worse because there is some effect in the non-operating line items, which are not shown on the summary, that are driven by the depletion of the cash balance that drive a loss of interest income, which was actually quite an important item for Rivian earnings, because Rivian, relative to its business size, sat on a huge cash pile, but that cash pile has been burned. So with that, this was part 5. I hope this was informative again, and hope to see you in the next one. Bye.